Hey everyone, welcome to the Industrial Insider Podcast. I'm Jonathan Gornstein, your host. Today I welcome back Raymond Wong from the Altus Group. He was a guest on the podcast in July of 2021, talking about industrial activity during the height of COVID. He is back with us to give us more facts, stats, and insider information about the industrial market. Raymond, so thank you for joining me, and I appreciate the time.
Thank you for having me.
My pleasure. So why don't we jump right into it? What were some of the highlights in 2021 that you saw in the industrial market?
Well, the industrial market is one of the least complicated of all the sectors, because and we've all been through the last couple of years with the pandemic and the increase in e-commerce, online shopping. So there's been a large demand for industrial space, and that's carried for, well, it's always been low in the way of availability rate, but especially in the last 2 years.
And then what's your prediction on 2022? I know we're currently in a lockdown. There's a lot of things up in the air, but what's your prediction on the next 12 months?
Well, if you look at the amount of new supply that hits the GTA every year, is between 10 and 13 million square feet. So we're on track to hit that number. Some of the challenges that I think we will see this year is, the continued increase in rents and as well as sale prices. And for industrial, the users used to make up a good 20 or 30% of the investment activity, but we've seen, especially in the past year, a bit of a decline there, just because of other sort of competitive investors and others getting into the marketplace. So we're starting to see that shrink, but and the challenge is that supply is not keeping up with demand, and that's going to continue this year. So anticipate higher rental rates, and as well as operating costs, especially how some of the industrial buildings are getting a lot more sophisticated in regards to higher ceiling heights, more automation, and the other issue that I think we had some challenges with this year is labor, and we're already seeing that on the trucking side and impacting the supply chain. So I think that's going to be a big movement this year. But again, from a demand perspective and from a pricing standpoint and rental standpoint, everything is still going to go up, and we're still going to have supply constraints in the marketplace.
I don't know if you know this stat offhand. How many square feet is the developer world going to deliver to the GTA? Would you know that stat offhand?
Yeah. So last year we hit around 11 million square feet, and I think this year, especially if you stretch it, not just GTA but GTH, and if you stretch it down to London, you're probably going to hit around between 12 and 14 million square feet. And it's really interesting with the GTH, because we talk about the GTA and the price points and the supply constraints. Now we're starting to move further down the 401 and further east, because from a pricing standpoint and from a labor standpoint. So from that perspective, the industrial market is getting larger, especially as tenants try to deal with higher operating and higher real estate costs. So it's going to be in that range, and the only constraint is land. And land, when you look at the overall investment activity, especially on the ICI basis, that there's been a lot more activity, especially in Caledon and Southwestern Ontario, London, and as well as, of course, moving east in Durham region. So the challenge is the acquisition or having the available land to build, but there's definitely a lot of demand for that new product.
Okay, so you said roughly about high level 15 million square feet being delivered to Toronto as a whole. Obviously, the Toronto GTA market is is in the top 5 largest industrial markets in North America. We can all agree on that.
Yeah.
Comparable to other markets that are similar size, would you know how many square feet are typically delivered to those markets, like LA, Chicago, any of these larger similar industrial markets?
No, it's we're in the top 5, right? So yeah, it's I think the US, you have a little bit more speculative construction there.
Yeah.
So I think the numbers are probably higher than the GTA. The Canadians usually, or industrial builders, seem to be a little bit more conservative on how much supply they bring on. That's how come the availability rate is so low. So when you compare the other U.S. markets, the availability rate is higher in over 6 or 7%. They still have a supply constraint, but there's more construction that's happening in those markets compared to the GTA.
Okay. Let's jump over to the investment side of the industrial world. Big buzzword in the industrial real estate is always cap rates. What are you seeing on cap rates over the next 12 months? I know we've all seen them compress and whatnot, but what are you seeing from the actual data?
Well, it's interesting for cap rates, and typically we look at the age of buildings. So based on transactions last year, so buildings built prior to 1970 were about slightly less than 4% cap rate, and this is a little bit surprising that built after 1991 have a slightly higher cap rate, around 5.1%. And it's the same thing with the Clear Heights, that for the Clear Heights, that we were finding that it was a lower cap rate for lower ceiling industrial buildings. And you would sort of think that it would be the reverse. But I think with the older product, that one, the location in an urban area. So the podcast that you had this week, Jonathan, on raising the roof is timely, because you're seeing a lot more of that, getting more out of that space based on the premium rents and pricing. So you're seeing a lot of that. But I'm not sure what your take is, whether or not we're seeing a big push on redevelopment of older sites.
Yeah, so previously I found when you show an investor an industrial product or an investment asset, the first question was always the cap rate, and would it fall within a range that they were typically looking for the returns. But over the last, I would say 24 to 36 months, that conversation has really shifted to looking at the bigger picture. Because sometimes on these transactions, the cap rate really doesn't make sense, given that the market has moved so quickly and people are willing to take a much lower cap rate if, like, in that situation where the rents are not at market or way below market. Like, we still have tenants in the market anywhere from, let's say, 7 to 850, and those cap rates are very compressed on an investment deal because they know they're going to get the pop on the renewal and turn it into, quote unquote, a market cap deal.
Yeah. And when you look at land prices, like Mississauga, you're still looking at around 2.5 million, and same thing with Markham at around 2.3. And it's not unless you go into that even Caledon, you're looking at north of 1.4. So unless you go out to Barrie or London, then you get into the 600. So that's some of those factors are driving pricing still, especially for the new stock.
In the, I guess, Toronto area, would you mark any particular submarket as a value add or undervalued market, just based on the data that you're seeing?
With industrial, it's tricky just because of all and it's not just industrial, but we saw it big time on the retail side based on location, redevelopment opportunities, higher type of mixed uses. So what we're finding is that play with some of the, especially institutional investors, that they'll pick up an asset and cash in on the rents until it's time for redevelopment. So there's a slight premium that's applied to that. So anything in the urban area with Toronto, Etobicoke, I've always liked, and Scarborough is getting a lot of attention now. And before
Yeah.
that used to be the lesser markets compared to the West, but based on the availability of land that, and as well as close to the urban area, close to population, that I think that's was always a bigger play. But you have to go now further east, and you have to play. And Amazon's been out there, and a few other sort of logistics companies. But that's the next play, especially with the amount of new infrastructure that's been built in the east, and
Yeah.
as well as going north as well. And we're this year we're definitely seeing the activity, along the 401 corridor with Southwest Ontario, and I like Hamilton as well, just because of the proximity and the airport there. So, Jonathan, I think I gave you the entire GTA market as a hotbed of activity. So, I apologize for that. I know you're looking for a niche there.
It's okay. It was a broker answer. You danced around the question. Just going back to your point, though, the East End has always been the quote unquote ugly sister of the industrial market. But as you know, clients are starting to ask way more questions about the East and starting to look for opportunities. And as you can see from the market, we're definitely seeing them, and we're seeing a ton of development.
Yeah, it's not just the industrial out there, but you look at the whole housing affordability, and you look at that growth in Durham region.
Yeah.
So one of the challenges with the East was the ability to find labor, especially not being on transit line and not having that population. But now you're seeing, one, the growth of the highways and infrastructure there. Two, you're also seeing the population growth. So you have a ready population that tenants can tap into. So I think it's a combination of not just on the pricing standpoint, but it's also that you're finding workers, that are people that are willing to move out there, especially from an affordability standpoint.
Right. Do you have any insight or trends that are impacting the industrial market? I know e-commerce is a big one, but are there any other key points that our viewers should at least have our eye on or the pulse on, that's really driving the industrial market?
Well, I'm not sure if it's as a driver, but another thing that we need to look at, last year was a little bit rocky based on the cost for construction, and it ranges anywhere from $90 to $130 per square foot, depending on the size. So the smaller the building, the higher the price per square feet. And because of the amount of inflation, and we're still having, because of the pandemic, labor shortages with some of the productivity with some of the manufacturers. So I think it'll be interesting that we're predicting about 5 to 6% increase in construction costs, but that may go a little bit higher based on what's going to happen with inflation and the shortages. So I hope that we're not going to go through that roller coaster we saw last year with lumber prices. But again, that's a bit of a concern of impact. But from a demand perspective, it's there. The challenge is whether or not the costs and the rents and the increases in prices may push out or cause a little bit more challenges with some of the tenants that are trying to stay within the GTA to be able to support their client base. So I think the concern going forward is cost, but from a demand perspective, both on the sale and the lease space, it's going to be another very active year this year.
I just want to go back to another point that you mentioned earlier, in terms of sales. You mentioned about 25% of the sales are only users. What is the other 75%? I guess obviously investors, but who is the other big component to that chunk of the pie?
It's private and institutions, and it's interesting that in the GGH, most of the buyers for industrial tends to be on the private side. In the GTA, it's a little bit more of a mix with, there's still predominantly private, but a good number of transactions by pension funds and with financial institutions. So, and I'm not sure if that's because of the type of product, but definitely the private sector still dominates.
For sure. Raymond, I think we covered a lot during this conversation. I want to say thank you for joining me on the Industrial Insider. If you have any questions, please feel free to email me, jonathan@leonard.com, or give me a call at 416-471-0904. And thanks again for tuning into the Industrial Insider. Raymond, thanks again.
Thank you, Jonathan.
Have a great day, everyone.